Hi, I'm Rick Kaler. Thanks for joining me. Well, last week I covered strategies for when to use Roth IRAs. An additional aspect that I want to cover this week of Roths is the benefit of being able to do a conversion from a traditional IRA to a Roth. It's best to consider doing a Roth conversion when your current tax bracket declines temporarily or is below the bracket you expect to be in when you're going to need to make withdrawals from your retirement account. Examples of two ways you might suddenly find yourself in a lower tax bracket are losing a job or having a bad year in a business that you own. The strategy is to estimate how much additional income would bring you to the top of the lower income tax bracket, then convert that amount from a traditional IRA into a Roth IRA. You will pay the tax on the amount converted just as if you had made a withdrawal from the IRA without the early withdrawal penalty of 10%. To make this strategy worthwhile, it's really important that the dollars used to pay the income tax on the converted amount come from a source other than the IRA. One of the challenges of negotiating a Roth conversion is knowing what your income will be for the year. This is something a person often doesn't know until late in December, which sometimes is too late for most custodians to start the mechanics of a conversion. There's an easy fix for this, according to Michael Kitces, who's editor of the Kitces Report. Deliberately convert more than enough to fill the income gap to the next bracket. Then, when you or your accountant finishes your tax return, simply send any excess amount converted back to your IRA. This is known as a Roth recharacterization. There are a few things that you need to do in order to make a recharacterization work. You need to put the conversion amount into a separate Roth IRA. Not commingle the funds with an existing Roth IRA. You also need to send the funds back to the traditional IRA by October 15th of the following year. Another strategy related to a recharacterization is being able to undo the conversion when the value of the investments in the recharacterized amount significantly decline in value prior to October 15th. Let me give you an example. Consider a scenario where you converted $30,000 to a Roth, and by September of the next year, the value of those investments fell to $15,000. You might feel pretty sad to pay tax on $30,000 that is now only worth $15,000. If this is the case, and you were in the 15% bracket, your tax would be $4,500, which is really almost 30% tax on the current balance of $15,000 that it's fallen to. In this case, you would want to undo the conversion by returning the $15,000 in this separate Roth conversion account back to the IRA from whence it came. If the opposite happens, let's say your $30,000 grows to $60,000 by September, well, happy days are here. You will still only pay tax on the $30,000 of $4,500 on that conversion amount, meaning the growth completely escaped taxation. To build on this strategy, Kitces suggests something else. He suggests converting several multiples of the desired conversion amount. So if that conversion amount was $30,000 and you had it, you might want to convert $90,000 or $120,000. Each $30,000 going into its own account, with each account invested differently. Whichever account and investment performs the best by around September can be the one you keep, with the remaining accounts recharacterized in time to meet the October 15th deadline. Now, some of these more complex strategies may not apply to many of you, and they may not be really scintillating information in which to be listening to either. Yet applying this information to your financial planning, if it's applicable, may provide some pretty exciting results 20 or 30 years from now. Thanks for listening.